Hello, future investors. Welcome back to Budgets and Beyond. Today, we're diving into the vast realm of investing, unpacking its various types in an easy-to-understand and engaging manner. So, let's get started. First up, stocks. Imagine walking into your favorite coffee shop, and instead of just buying a cup of coffee, you buy a small piece of the business itself. That's essentially what you're doing when you buy stocks. You're purchasing a slice of a company. And as that company flourishes, the value of your stock piece also expands. There are two main types of stocks that you can invest in: common stocks and preferred stocks. With common stocks, you're like a mini owner of the company, enjoying voting rights in company decisions. On the other hand, preferred stocks may not give you a seat at the decision-making table, but they offer a steady stream of dividends, which is like a regular payout for being a shareholder. Whether you choose common or preferred stocks, the key is to do your research. Look at the company's health, its future growth prospects, and the overall market trends. Remember, as the company grows, so does the value of your stock. But the reverse can also be true, so it's essential to think long-term and be patient with your investments. Next, let's talk about bonds. Picture a bond as a friendly loan you're extending to a company or even a government. It's a bit like lending money to a friend, except in this case, your friend is a corporation or a government entity. They promise to pay you back with interest over a certain period of time. It's a win-win, really. You get your money back with a bit extra, and they get the funds they need for their projects. Now you might be wondering, are bonds risky? Well, in the world of investing, nothing is without risk. But compared to stocks, bonds are usually seen as the safer option. Why is that, you ask? It's because bonds come with a promise of repayment. If you hold on to your bond until it matures, you're guaranteed to get your initial investment back, along with the interest. However, the flip side to this safety is that bonds typically offer lower returns than stocks. So while they're a more stable investment, they might not make you a millionaire overnight. But hey, who said slow and steady couldn't win the race? Bonds are generally considered safer than stocks, but they also usually offer lower returns. Mutual funds are up next. Picture a giant pot of money, contributed to by many different investors. That's essentially what a mutual fund is. It's an investment vehicle that pools together funds from a multitude of investors and uses that money to buy a diversified mix of assets. Now, why might you choose to invest in mutual funds? Well, firstly, they offer diversification. This means that the money you put into a mutual fund is spread across a range of different investments. So instead of putting all your eggs in one basket, you're spreading them out, reducing the risk of losing all your investment if one company doesn't perform well. Secondly, mutual funds are managed by professional fund managers. These are folks with a wealth of experience in the financial markets, who make the investment decisions on your behalf. This can be a great option if you're new to investing or if you simply don't have the time to manage your own investments. Lastly, mutual funds give you access to a broad range of assets that you might not be able to afford individually. This means you can benefit from investing in higher-priced assets without needing to cough up the full price yourself. It's a great way to diversify your investment. Similar to mutual funds, we have ETFs or exchange-traded funds. These are investment funds traded on stock exchanges, much like individual stocks. They're designed to track the performance of a specific index, sector, commodity, or asset. The beauty of ETFs is that they offer the best of both worlds, bridging the gap between mutual funds and stocks. Like mutual funds, ETFs allow investors to spread their risk by investing in a diversified portfolio. This means that instead of putting all your eggs in one basket, you're spreading them out across multiple baskets. This diversification can help protect you from the volatility of the market. But here's where they differ from mutual funds. While mutual funds are priced at the end of the trading day, ETFs are bought and sold throughout the day, just like stocks. This means you can buy or sell ETFs at any time during the trading day at a price that's constantly changing. So if you're looking for a way to invest in a diversified portfolio, but also want the flexibility to buy and sell whenever you want, ETFs could be a great option for you. They offer the diversity of a mutual fund with the flexibility of a stock. Real estate investing can be exciting. It's more than just buying a house to live in. It's about acquiring properties to generate income. either through rental income or through buying and selling at a profit. This type of investment can involve a variety of property types, from residential homes to commercial properties, and even vacant land. Now, real estate investing does require more capital upfront compared to other types of investments we've discussed. It also includes ongoing costs like property management, maintenance, and taxes. But don't let that deter you. With careful planning and smart decisions, these costs can be offset by the potential income and appreciation of the property over time. One of the key advantages of real estate investing is the potential for steady cash flow. Rental income can provide a regular and stable source of income, which can be particularly attractive for those looking to supplement their regular income or fund their retirement. Moreover, real estate can act as a hedge against inflation. As living costs rise, so too can rental income and property values, helping to protect your investment against the eroding effects of inflation. In conclusion, while it requires more hands-on management and a significant upfront investment, real estate can be a solid long-term investment and a hedge against inflation. Commodities include physical goods like gold, oil, or agricultural products. These are essential items that drive the global economy, and they offer yet another avenue for investment. But how does one invest in commodities, you might wonder? Well, there are several ways. You could buy the physical commodity itself, but storing it can be a challenge. Imagine having a barrel of oil in your backyard or a silo full of wheat. Not the most practical, right? So for most investors, commodity futures are a more viable option. These are contracts to buy or sell a specific commodity at a predetermined price on a specific future date. It's an agreement to trade without needing to store the physical commodity. Commodity ETFs and mutual funds also provide exposure to commodities, often tracking the performance of a commodity index. Now, investing in commodities isn't for the faint of heart. Prices can be extremely volatile, influenced by factors like weather, geopolitical events, and changes in supply and demand. However, commodities can offer a hedge against inflation and currency fluctuations, and as part of a well-diversified portfolio, they can help spread risk and potentially enhance returns. So, while it carries its own set of challenges, investing in commodities can be a good way to diversify beyond traditional stocks and bonds. And that's a wrap on the basic types of investing. We've journeyed through stocks, bonds, mutual funds, ETFs, real estate, and commodities. Each offers unique opportunities and risks, tied to your financial goals and risk appetite. So keep exploring, keep questioning. The world of investing is vast and waiting for you. Until next time, keep learning and start investing.